Hello everyone, I'm Ryan Chan, the CEO and founder of Upkeep. Today, we're going to explore a fundamental concept that can greatly impact your maintenance decisions and financial planning: equipment depreciation. We'll delve into what it is, the key factors to consider, and how to calculate it. We'll also discuss how understanding depreciation can help you make smart decisions regarding your assets, especially older ones. Let's get started. Equipment depreciation is a vital concept to grasp, especially when making maintenance decisions for your assets. It's essentially a measure of how much a piece of equipment drops in value each year. To understand equipment depreciation, there are three key factors you need to consider. First, the initial value of the asset. Second, its useful life, which is the number of years it takes to fully depreciate. Finally, its salvage value, which is the value of the asset when you decide to sell or scrap it. The useful life of an asset could be based on either manufacturer information, user estimates, or values assigned by the Internal Revenue Service. Now let's talk about how to calculate equipment depreciation. The simplest method is the straight line method. Here's how it works. Subtract the salvage value from the initial value and divide the result by the useful life. This gives you the annual equipment depreciation. For example, if an asset costs $9,000 at the start, has a salvage value of $2,000, and has a useful life of 7 years, your depreciation would be $9,000 minus $2,000 divided by 7 years, which equals $1,000 per year. This means that each year, your equipment is worth $1,000 less than the year before. Knowing the worth of your equipment is crucial when planning maintenance tasks. By tracking the depreciation of your assets, you'll have a clear idea of just how much your equipment is worth. This is particularly useful for older equipment. If the cost of repairs would be more than its current value, it might be a better idea to replace it instead of fixing it. Depreciation also plays a role when calculating taxes. Organizations can write off the depreciation of their equipment as a business expense, which could help lower their tax exposure. This also has implications for maintenance planning. If you're no longer able to claim tax benefits from an asset, it might be less worthwhile to keep maintaining it. To get the most out of depreciation, you'll need to keep track of it on each asset. Certain types of software systems can help you do this. By using depreciation as one of your metrics, you'll be able to determine the most financially efficient course of action regarding older assets. So that's a quick rundown on equipment depreciation. Understanding this can help you make smarter decisions about maintenance, asset management, and financial planning. As we wrap up, thank you for watching. We've covered the key concept of equipment depreciation, its calculation, and its impact on maintenance decisions and financial planning. Don't forget to subscribe to our channel for more informative videos like this one. For more resources and tools to help your maintenance and reliability teams be more successful, visit us at upkeep.com. We look forward to seeing you in our next video.